Hey guys, in this video, let's talk about financial assets, which are debt instruments, right? Financial assets, which are debt instruments. For example, guys, you invest in a loan note, right? You invest in a loan note. For you, it's a financial asset. Why? You have a contractual right to receive cash. So it's a financial asset, which is a debt instrument, right? So for financial assets, which are debt instruments, now let's look into the initial measurement and subsequent measurement, right? For initial measurement, guys, you have to always record it at fair value, right? At fair value. That is the cash proceeds you invested, right? So the point is what to do with the transaction cost, right? What to do with the transaction cost. This will depend on your subsequent measurement, right? This will depend on your subsequent measurement. If you choose fair value to profit or loss, FVTPL, then the transaction cost should be expensed to statement of profit or loss as an expense. Okay. If you choose FVT OCI, fair value to other comprehensive income, as your subsequent measurement, then you have to capitalize the transaction cost as part of the asset. If you choose amortized cost as your subsequent measurement, you have to still capitalize the transaction cost as a part of the financial asset. Okay. Then let's move on to subsequent measurement, guys. So with regards to subsequent measurement of financial assets, which are debt instruments, you have three categories, right? So you can go to any of the categories based on your intention, guys, right? It is actually based on your intention. So to find out what category we have to use, right? There are two types of test, right? First test is called, guys, business model test. Second test is called contractual cash flow characteristic test, right? That's just for your knowledge, guys. It's not required for you to remember, right? Just understand with regards to subsequent measurement, there are three models: FVTPL, FVT-OCI, and amortized cost, right? So FVTPL, right? So you are purchasing this financial asset, right, for short-term trading purpose. Then you have to record it under FVTPL. Then transaction cost should be expensed to statement of profit or loss. Fair value gain or loss should be taken to statement of profit or loss, right? FVT OCI. What is the situation that you will need to use FVT OCI as your subsequent measurement for financial assets, which are debt instruments? So this is the scenario, guys, right? You have a long-term intention to hold the financial asset to collect the contractual cash flows, which is interest income, right? But if you get a good price for the financial asset, you will sell it, right? So if that qualifies both the characteristics, guys, you are holding it for long-term purpose to collect the contractual cash flows. But if you get a good price, you will sell the financial asset. Then if that is the case, you have to use FVT OCI as your subsequent measurement. Okay. Then capitalize the transaction cost as part of the financial asset, and fair value gain or loss is taken to other comprehensive income or OCI. Okay. Then amortized cost method, right? Amortized cost method. When do you need to use the amortized cost method? So that is where, guys, you are holding the financial asset for long-term purposes, right? You are holding it for long-term in order to collect the contractual cash flows, which is interest. Okay. So then you have to capitalize the transaction cost out of the financial asset. Then for accounting purposes, you will need to use something called the amortized cost table, right? Now let's look at the amortized cost table, right? So this is the format of the amortized cost table, guys, right? Do remember this format, very, very important. First column here, then we have balance brought forward, interest income, that is balance brought forward into effective rate of interest. Then we have interest income received in cash, that is nominal value into coupon rate. Then we have carried forward, right? So brought forward plus interest income minus interest income received will give you the carried forward answer. Okay. So this interest income column, guys, you have to record it in statement of profit or loss as an income, right? This column, interest income received, right? This you should record in the statement of cash flows. Okay. This carried forward column, you have to record the year-end balances in the statement of financial position. Okay. Now let's look at an example, guys. Right. This is the amortized cost table that I already explained. Now let's look at an example with regards to amortized cost. Okay. Read along, guys. Chandler invests in a $100,000 loan note of Company Rock. He incurred a transaction cost of $1,000. Coupon rate is 10% and the effective rate is 20%. He holds this loan note to collect the contractual cash flows for 4 years, that is until redemption. What is the balance of the financial asset after 2 years? Okay. So what is the subsequent measurement model they have used? Since Chandler is holding the loan note up until redemption in order to collect the contractual cash flows, right? You have to use what method, guys? You have to use the amortized cost model, right? You have to use the amortized cost model. So in amortized cost model, the transaction cost, what do you need to do? You have to capitalize the transaction cost as part of the financial asset. So initially you have to capitalize the transaction cost as part of the financial asset. So double entry will be, guys, debit the financial asset $1,000, right? Credit the cash or bank $1,000, right? So I have shown here the capitalization of the transaction cost. Okay. So the initial value of the financial asset therefore will be $101,000, right? $101,000. Okay. So then we have to put this $101,000 here as the brought forward for year 1, right? Then you have to calculate the interest income that is brought forward into effective rate of interest, which is 20%, will give you this answer. Then you have to minus interest income received, that is nominal value into coupon rate. Nominal value is $100,000 into coupon rate, that is 10%, guys. So that will give you this answer. This is constant, guys. This will not change throughout the years. This is constant. Okay. Then you will get the carried forward. Then here the carried forward balance becomes the brought forward here. And again, guys, similarly, if you account for it, right? If you account for it, you will get the answer that is required, right? The year-end balance after 2 years. So now, guys, this video, right, is all about financial assets, which are debt instruments, right? I hope you understood the concepts and theories, guys. Go through this again, take some screenshots, do this example by yourself, try to understand the concepts, guys. This is very easy, right? Just keep a simple understanding about this standard, guys. So thank you for watching. Let's meet in the next video, guys. Thank you.